Okay, so what if I told you that getting wealthy, like really wealthy, has way less to do with your paycheck and almost everything to do with, well, just how you act? You know, like how some super smart, high-earning folks can actually end up broke. But then you hear about a janitor who retires with millions. It kind of flips the script, doesn't it?
It absolutely does. And that's really the core of what we're digging into today in this deep dive. We're looking at the key ideas for financial success, mostly drawing from Morgan Housel's book, The Psychology of Money.
Right. Great book.
Yeah, phenomenal. We pulled out some key bits that show how money really works, you know, in the actual world. And yeah, it often turns what we think we know completely upside down.
So our mission here, really, is to explore why understanding your own psychology, your own behavior, is maybe even more important than knowing all the ins and outs of the stock market.
Exactly. Think of it like a shortcut to the financial insights that actually last. Timeless stuff.
And the promise to you, listening, is that by the end of this, you'll have some really solid, actionable ideas about building wealth that lasts. Stuff that actually works.
We're focusing on what actually works.
Okay, so let's dive in. We often make finance seem so complicated, right? Like it's all about algorithms and knowing the future. But Housel's big idea, the foundation really, is simpler. Financial success isn't really about math, it's about behavior.
Yeah, he really nails this early on. It's kind of radical because we're all taught to focus on, data, complex strategies, getting smarter.
Right, more information.
But he argues pretty strongly that doing well with money isn't like physics. It's not about IQ points. It's much more about emotional intelligence.
Okay.
He actually says, doing well with money has little to do with how smart you are and a lot to do with how you behave. That really reframes it, doesn't it? It's about managing yourself.
It really does. And he uses that example of Ronald Reed, the janitor from Vermont, who somehow died with, $8 million? It just seems so unlikely. What did he do that all these supposedly smarter, higher paid people miss?
Well, it boils down to consistency and humility, I think. He lived simply way below his means. He started investing early. And the crucial part, he just kept at it for decades.
Decades. That's the hard part.
That's the hard part. You compare that to, say, some high-flying professionals. Sometimes that they're trapped by what people call lifestyle inflation.
Fancy car syndrome.
Exactly. Your spending just keeps pace with your raises, so you never actually get ahead, or just, bad habits. So Ronald Reed's story, it just shows that discipline, that steady approach. It really can beat raw intelligence or high income. Sensible actions win out.
That idea of sensible, consistent action, it flows right into the next big point, which is the incredible power of compounding. Housel makes a really strong case that time might just be your most powerful financial weapon.
Oh, it's mind-blowing when you really grasp it. Look at Warren Buffett. Something like, 99% of his net worth came after his 50th birthday?
99%. That's wild.
It is. And it wasn't some magic stock pick he made when he was 50. It was because he started investing as a teenager and just never stopped. That longevity, that commitment, that's the secret sauce.
And he's got that quote, right? Something like, good investing isn't about making amazing decisions.
It's about consistently not screwing up.
Yeah. It's such a different mindset, isn't it? Less about finding the winners, more about avoiding the big mistakes. Patience pays off.
So starting early is key, even if it's small amounts.
Absolutely. The sooner you start, the less heavy lifting, maybe even less risk you need to take later on. But the challenge, and this is a big one.
Yeah.
Compounding is slow at first. Those early gains feel tiny, almost invisible. It takes real patience. A lot of people just give up too soon because they don't see those huge results right away.
It's like planting a seed and expecting a tree tomorrow.
Exactly. You gotta wait. But eventually, if you stick with it, you get that forest. Okay, so sticking with it helps you build wealth. But what about keeping it? Housel makes this really interesting distinction. Getting wealthy and staying wealthy are actually two very different skills.
Oh, completely different beasts. Getting rich often involves taking smart risks, maybe being a bit optimistic, seizing opportunities.
Right, you gotta put yourself out there.
But staying rich, that takes something else. It often requires humility, caution, Survival mindset, almost. Housel has this great line. He says, the hardest financial skill is getting the goalpost to stop moving.
Ah, yes. That constant desire for more, the bigger house, the faster car, keeping up with the Joneses.
Exactly. That chase feels like progress, maybe, but it can be the very thing that destroys your financial security long term. It's a dangerous trap, always needing more.
So how do the truly wealthy, the ones who stay wealthy, behave differently?
Well, often they build what Housel calls a margin of safety, like a buffer. They stay liquid, meaning they have cash available. And crucially, they see money less as a status symbol and more as a tool.
A tool for what?
For freedom, mostly. Options. Control over their time. It's about what the money allows them to do, not just what it can buy to impress others.
That makes sense. Okay, let's shift gears slightly. You mentioned things we overlook. What about luck and risk? These invisible forces. Housel really emphasizes their role, but we tend to downplay them, don't we?
We really do. It's sort of a cognitive blind spot, maybe. We love stories about pure skill and hard work leading to success and pure foolishness leading to failure.
We like clear cause and effect.
Exactly. But reality is messier. Housel argues that what looks like genius often had a healthy dose of good luck, and what looks like a terrible decision might have just been bad luck. He uses Bill Gates as an example.
Oh yeah, the computer access thing.
Right. The fact that he went to one of the very few high schools in the entire country that had a computer back in 1968, that was a huge lucky break, an unbelievable advantage.
You can't really replicate that luck.
You can't. And that's the insight. Don't judge financial outcomes, yours or others, too harshly, without factoring in luck and risk. Things happen, good and bad, that are outside our control.
So for you listening, the practical takeaway isn't to try and copy Bill Gates' exact path.
No, impossible. Instead, focus on the underlying principles that successful people often share, principles you can control. Thinking long-term, maintaining that margin of safety we talked about, being humble, being patient.
Okay, that leads nicely into another principle that feels a bit counterintuitive. Save money, even if you don't know what you're saving for.
Yeah, most of us save with the target, right? Retirement, a house deposit, a new car, a holiday.
Exactly. Gotta have a goal.
But Housel suggests something kind of radical. Just save, period. Save without a specific goal attached.
That feels aimless. Like, what's the point?
Well, the point is that life is unpredictable. Unexpected stuff always happens. Recessions hit, people lose jobs, emergencies pop up, or maybe an amazing opportunity comes along that needs capital.
Right, you need a cushion for the bad stuff and fuel for the good stuff.
Precisely. As he puts it, savings without a spending goal gives you options and flexibility, the most valuable currencies in finance. It's like buying yourself freedom and agility, and it's a habit you see often with wealthy people. They don't necessarily earn vastly more, but they consistently save a higher portion of what they do earn.
Options and flexibility. That ties into the next idea, which really resonated with me. It's about redefining wealth, not just as money, but as freedom. Specifically, freedom over your time.
That's maybe the ultimate goal, isn't it? Housel says, controlling your time is the highest dividend money pays.
The highest dividend. I like that.
Think about it. Waking up without an alarm clock because you choose to. Working on projects you actually care about. Being able to say no to things that drain you, that's real wealth.
And importantly, that kind of wealth, that control over your schedule, it doesn't always mean you need to be a millionaire, does it?
Not necessarily, but it absolutely demands being intentional with your money. It's about using your finances to design a life that gives you that control, that choice.
Which requires making decisions. And this brings us to another key point. We need to be reasonable, not necessarily perfectly rational.
Because we're human. We're emotional creatures, not spreadsheets. And Housel argues that's okay. Trying to be perfectly rational all the time is exhausting and, frankly, impossible.
So forget pure logic.
Not entirely, but aim for reasonable. What does that mean? It means invest in things you actually understand. It means, crucially, having a plan you can emotionally stick with, especially when things get scary in the markets and everyone else is panicking.
Sticking with the plan. That sounds simple, but it's hard.
It's incredibly hard. But as he says, the best financial plan is the one you'll actually stick with. It has to work for you. Maybe that's simple index funds. Maybe it's real estate. Maybe it's building your own business. The best plan is the one that fits your life, your personality, and that you won't abandon when things get tough.
Okay, final big idea, and this one really challenges how we see success. Wealth is what you don't see.
Right. We see someone driving a fancy car or living in a huge house and we think, wow, they're rich. That's visible spending.
That's the stereotype.
But Housel argues that true wealth is often invisible. It's the money not spent on the fancy car. It's the investments quietly compounding in an account somewhere. It's the assets growing behind the scenes. It's the choices made not to spend.
So the flashy stuff is often the opposite of wealth.
It can be, he puts it very bluntly. Spending money to show people how much money you have is the fastest way to have less money.
Ouch. But true. So real wealth isn't the display. It's the security, the options.
Exactly. It's freedom, peace of mind, flexibility, that quiet financial strength. That's the real goal.
So pulling it all together, the big lesson from the psychology of money, it seems, isn't about mastering complex finance.
No, not really. It's about mastering yourself, understanding your own biases, your emotions, your behavior, developing discipline. Those are your most important financial assets.
This whole deep dive, it really shifts the focus, doesn't it? Away from just charts and numbers and towards the human side of money. Our own minds are where the real battles are won or lost.
Absolutely. Which brings us to a final thought for you, listening. After hearing all this, are you really in control of your money decisions, or are your emotions maybe subtly pulling the strings?
Yeah, maybe take a second and think. Which of these ideas really hit home for you? Was it about behavior, compounding, luck, freedom?
Reflecting on that might just give you a new insight into your own financial journey and maybe help you build a little more of that real wealth, the kind that gives you freedom and peace of mind.